Once you start your wealth journey, the next question is going to be, how do I grow my wealth? How do I double my wealth? Because the faster that you can grow and double your wealth, the wealthier you're going to be. Because now you can just keep stacking and doubling and growing and compounding and building your wealth. And there's a couple different ways that you can do that. And you don't have to quit your job and go and become an entrepreneur to do this, but there's a couple ways that you can do it. One is you can go out and actually create something on your own. Or second is, how do you now increase the amount of wealth that you're building and increase the speed at which your wealth is growing? Because it all comes down to the velocity of money. The faster you can grow your money, the faster you can grow your wealth. And this is where now understanding the difference between, I'm going to throw my money into a savings account and get 1% a year on my money, or I'm going to put my money into a business, into my own business idea, and get 100% return a year on my money. Putting your money into a business and getting 100% return is way riskier than throwing your money into a savings account and getting a 1% return on your money. And that's different than also throwing your money into a brand new car that's losing 20% a year on your money. But this is where now, between the savings and your business, you got to find the right velocity of money for you, and that's going to depend on your risk tolerance. It's going to depend on your education level. It's going to depend on your interest level, and it's going to depend on how much work you're willing to put in as well. Because in the middle, you have all of your other investments. You have your stock market investments. You have your real estate investments. But then even that have their own ranges. Are you going to be investing in individual companies and trying to find the next big company that you want to invest in? That's going to give you a higher velocity potential. Or do you want to just throw your money into ETFs and index funds? Lower return potential, but also less risk. And this is where now you have to understand, how much risk are you willing to put in? How much time are you willing to put in? And understand that velocity of money. That way you can be realistic with the amount of wealth that you want to build and make sure that you're on the right path. If you say that you want to fly in private jets, you want to have a big, nice home, you want to drive in the Rolls Royce, and the way you're doing that is by putting $400 a month in your index fund, you're lying to yourself. How are you going to go from that index fund to the Rolls Royce? You got to look at the velocity of money and make sure that the velocity of money that you're using is aligned with the goals that you want to live. So now, if you want to go out and create something, well, that's possible. If you live in a first world country like the United States of America, you have more opportunity here than anywhere else. There's a lot of people that say otherwise, but the reality is you have more opportunities here than anywhere else in the world. Is it perfect? No, absolutely not. But you have more opportunities here. Now, the name of the game is, how can you build something? How can you make money? And how can you create something beyond you? There's a book called Built to Sell that will teach you how to build a business that doesn't just rely on you. But now the question is, what do you actually do to go out and make money? What value, what service, or what product can you create that will get people to want to open up their wallet and give you their credit card number, or give you a check, or give you their cash? That way now you get the money, and in exchange you get a product. And if you want to be able to scale that, you have to have something that you can create more of. Because now if your product is, I'm going to come in and I'm going to give you my consulting. I'm going to tell you what clothes to wear based off of my fashion consulting service. I'm going to tell you how to grow your business based off of my business consulting service. And it relies on you. You're going to have a very tough time scaling. That was a problem that I dealt with, because in the beginning I had an event planning company where I used to host parties. I used to work at weddings. And I started to make more money because I got good at what I was doing. I worked there for a number of years, and then I started to charge more money for my services. But if I wasn't working, I wasn't getting paid. That scaling potential was so limited to just my income potential. But now if you can build something, let's say you sell mugs, you can hire people to build these mugs. You can create more of these things and focus on the marketing. Because if you're spending your time on the growth side of getting customers, of getting sales, well, now you can scale this so much more, because now you can hire people to continue building more. You don't have a supply limitation. Your limitation is on the demand side. That is where real success and wealth is built on the business side. If you can continue to grow the supply, you don't have the supply caps, and you spend your time focusing on the demand side. Meaning you spend your time on the growth, on the customers, on the marketing side. If that's a business that you can build, now you have a real business that you can sell, that you can step away from, that you can have another CEO run. Because now if you focus on building something that you can hire people or build systems to create the product for, and your job is to get more customers, well, now you can just keep working to get more customers. Now the game is, how do you find the right marketing to get people to buy your stuff? But it requires a good product that people want to pay for, that you can scale. And that's where real wealth is built in the entrepreneurial side. But now what if you don't want to build a business? What if you don't want to quit your job? That's okay. How can you now double your wealth? How can you create more wealth through something that you own without having to create it yourself? And this is where now it goes back to the velocity of money, where now the faster that you can grow your money, the faster you can invest your money, the wealthier that you're going to be. Let me start by showing you why the velocity of your money is so important here. If you can invest $500 a month and you do this for 40 years, the amount of wealth that you're going to build is going to depend on the velocity of your money, meaning what type of rate of return that you get. Whether you get a 5% return annually, a 7%, or a 10%. Now, this doesn't mean that you're going to get this return every single year. I'm talking about the average. So some years you might lose money, some years you might make more money. But on average, if you get a 5, 7, or 10% return, it's going to determine how wealthy you will become. And all three of these numbers are very accessible and achievable. Just depends on how much education and time and work you're willing to put into your passive investments. If you get a 5% annual return on your money, you're going to end up with about $750,000 with your $500 monthly investment. If you get a 7% annual return, you're talking about $1.2 million with your passive investments. And with the 10% annual return, now you're talking about $2.9 million worth of wealth from your investments. That's a big difference between here and here, but it's both very accessible. It just depends on what is the velocity of your money and how fast you can grow your money. I'm going to jump back into the video in just 1 second, but before we do, if you want to learn and build on top of your financial education, we have a free ebook in my Market Insiders company, which goes over how you can start investing your money, how you can start generating cash flow, and how you can start putting your money to work even if you don't have a lot of money to invest. This ebook is completely free, and it'll walk you through different investment strategies, how you can start investing, how you can start investing in stocks, how you can start investing in real estate, and how you can start getting cash flow on the money that you invest. So if you want to learn more about how to start investing and you want to build on top of your financial education, this is a completely free guide that you can read and access. So if you want to read the guide from Market Insiders, I got the link to how you can download this ebook for free down in the description below. Let me break this down. The velocity of money that you're going to get is going to depend on how much risk you're willing to take on and how much work you're willing to put in. So the way we can break this down is now understanding the difference between being an active investor versus being a passive investor. And we can start by talking about this in the stock market because that's probably the most accessible and easy way to understand the way that it works. In the stock market, there's a couple of different ways that you can invest your money. You can invest your money by putting your money into individual companies, like the Amazon stock. If you invest your money in Amazon, you are betting that Amazon is going to grow, make more money, and become more valuable. Now, in order to do that and actually make money, you're going to have to put in the work to learn about the Amazon company, to study the Amazon financials, learn about their products, keep up with the company's doing, and make sure that the company is on track to continue growing. That way you continue to make more money. That's option one. That's more of an active investment. This is what Warren Buffett is doing. He's spending his time learning about companies, reading their financials, learning about who's running the companies. That's what his life revolves around, is to study companies, find companies that are undervalued, buy them, and hold them for a long time. Option two is being a passive investor. This is where now, instead of investing in a company like the Amazon company, you can invest in a fund that will give you exposure to a lot of companies. For example, there are ETFs, exchange traded funds, that give you exposure to the S&P 500. One example of this is SPY SPY. SPY will give you exposure to the 500 largest companies in the stock market. So if you go out and invest in that one ticker symbol, I'm not telling you what to invest in, just giving you an example. If you go out and you invest in the SPY ETF, you are going to own essentially 500 of the largest companies on the stock market. One of those companies is Amazon today. So now, you don't have to go out and learn about all 500 of those individual companies. You're just investing in that broad group. Now, your risk is much less because if one of the companies you invest in goes bankrupt, you have 499 other companies to balance it out. But that also means your upside is limited, because if Amazon were to take over the world, well, yeah, you're going to benefit because it's in your ETF, it's in your fund, but it's going to be balanced out by some of the losers. So lower downside, lower upside. And you also get to save a lot of time, because now you don't have to worry about so much Amazon and what they're doing, what their products are, who their executives are. You don't have to study their financials. So now as a passive investor, you don't have to worry so much about what is going on with the individual companies. You just find the right fund. And the way that you win is you create a system where every week, every 2 weeks, or every month, you just continually keep buying more of those funds. It does not matter if the market's up. It does not matter if the market's down. You just keep buying more no matter what. That's how you build wealth over the long term, is if you invest in funds that give you broad exposure to the markets and you just continue to ride the market, because now if the American economy grows, your thinking is that these funds will grow as well. With the individual companies, it's different, because now you have to find the right company and you have to own it for the long term, and you have to make sure that this company continues to grow, because now if you invest in the Amazon company and they go bankrupt, you just lost all of your investment. But if Amazon takes over the world, now you can see a huge return on your investment. So you can start to see that risk and reward. The more risk you take, the more rewards that you can get. If you want to be an investor in individual companies, you better be investing in your financial education of learning how do you analyze companies, how do you study financials, how do you learn what an income statement is, how do you study cash flow statements, how do you study balance sheets, how do you actually value the companies. This is a whole education in and of its own. And the more you learn, the better you're going to be able to do. Anybody can go out and invest in a company, and yeah, maybe you'll hit a couple of good companies here and there, but if you really want to increase your odds of good returns, and you want to increase the types of returns that you get, that's where you have to be investing in your education. On the passive side, it requires much less effort on your end. Now, you don't have to pick one or the other. I am both. I have a system where I am passively investing my money, and I also actively invest my money. I have a system where every week, for me it's every Wednesday. I don't have a special sauce or science for why Wednesday. I just do Wednesday because I used to have it on Monday and Friday, but then sometimes the markets will be closed on Mondays and Fridays, so I just pick the middle of the week. But every Wednesday, I have cash that's pulled out of my checkings account and is automatically invested into my portfolio of ETFs. I have ETFs that give me exposure to value. I have ETFs that give me dividends. I have ETFs that invest into international companies. And I have ETFs that invest in innovation. So now, every Wednesday, I have cash pulled out of my account that's invested into these ETFs. There's a bunch of great platforms that specialize in this for you. I have the company who is an affiliate of mine, meaning if you use them, we will get compensated. Down in the description, if you want to learn more, but you can do your own research, find the right company for you. The company that I use is called M1 Finance. I like them just because, well, it's super simple. They specialize in this type of passive investing. So I'm a huge fan of them. But again, I want you to do your own research. If you want to learn more about M1 Finance, I got the link to my affiliate code down in the description if you want to check them out. But that happens for me on the passive side. On the active side of my investments, it's very different. Now I'm looking for individual companies. Now I'm looking for good companies that I believe are undervalued today, that I believe have a lot of growth potential. Now this for me, I enjoy it because I like researching companies. I like being involved with companies. I'm an entrepreneur and I like studying companies. I like seeing what companies do. I like watching companies that are innovative. I like learning about who started a company. And before, like 10 years ago, it was a lot more difficult to understand who's actually running a company and their missions and their beliefs unless they wrote a book or unless they were interviewed somewhere on TV. Today, if you're looking at investing in a company, look at who is the CEO. Look at who's running the company. You can go onto their Instagram page and see how passionate they are. If they're out there talking about what they're doing and if they're out there publicly doing things about the company. Look at how innovative the company is. Are they creating a product that has lines around the door? Do they have something that's underserved that they're creating? Then do the financials make sense? Again, I like doing this, which is why I do it. You don't have to do this. This is something that I'm interested in, which is why I do that. So now, my active investments have more risk. I have some investments that have lost me money. I have some investments that have made me a lot of money. My passive investments are much lower risk, where now I know that this is a long-term game. The way that you win as a passive investor is you invest for multiple decades. That is the way that you win. But now, different velocities of money. You could do the same thing with real estate. I am a real estate investor. I love investing in real estate because I love the cash flow that you can get from real estate. When I invest in real estate, I am actively involved. I'm going out and I'm looking for properties to purchase. When I buy a property, I bring in my contractor who will renovate the property because I like my properties to look very nice. So I'll buy a property that's beat up, that's distressed, that looks ugly. We'll completely renovate it, remodel it, and now it looks like a brand new home that somebody will want to come in and live in and use and then pay rent. And so now I'm involved up until we get the tenant involved, because then I have a property manager who does everything after that. But it is an active investment because I'm actively looking for the investments to purchase. There are passive ways for you to invest in real estate as well. If you are interested in investing in real estate, but you don't want to put in the time or the effort, or you're not interested in dealing with tenants, well, then you can go to real estate investor conferences, because there's always people that are looking for money. Always. And you can be one of the investors into these deals. These are called syndicate deals, where now an investor, a developer, somebody is putting together a project. Maybe this person wants to go out and build or buy a hotel complex. Maybe they want to build or buy an apartment complex, but they need a certain amount of money. They need cash to go out and do it. And this is where now they're going to try to find people who have money, who want to give them the money in exchange for a piece of ownership in that deal. Now, of course, you have a little bit less risk because now your time is not going to be at stake. You're really just investing your money, and you don't have to put in all the money, but there's a chance that the deal can go under. That's your risk. So now you have to trust the person, you give them your money, and then it's their job to take your money and purchase this asset, renovate it, rehab it, rent it out, generate cash flow, and maybe sell it for a profit or refinance it. That way you can get your money back. You would probably be a silent investor in this case, but it's a way now for you to invest in real estate with less cash and to be completely passive. There's also platforms online that allow you to do this with smaller amounts of money, which are building systems. Again, is there risk? Of course. There's a risk that your investment platform will fail. There's a risk that the real estate investment deal will fail and you lose everything. That is a possibility. That's a possibility when you invest your money. But this is where now your due diligence and research is important. Now, if you want to see platforms that can do this, again, I have an affiliate link with companies that I have used in the past. You can check that out down in the description. But this is where you want to do your research, understand that investing has risks. When you are a passive investor, you generally have less risk, but it doesn't mean that you have no risk. And so understanding the risk and understanding the returns that are potential, and knowing now if the returns that you're trying to get are in alignment with the lifestyle that you want to live. Just go to Google and search a compound interest calculator and see how long will it take you to get to where you want to go based off how much money you're investing, based off of the type of returns that you're getting, and then see if it just makes sense. If you need a 4% return on your money to be able to live the life you want, well, then you don't have to be taking all the risks that you need, that you might think that you need in order to get that return, to get that wealth. If you need a 300% return on your money in order to go out and live the life that you want, well, you're going to need to start making more money. And this is where now you have to just make sure that your lifestyle is in alignment with what you want to achieve in life, and just make sure the numbers make sense. See, everybody wants to become rich, but only a fraction of those people who want to become rich ever will achieve any sort of financial freedom. The question is, why? Is it because the system is rigged against you? Is it because of your work ethic? Or is it because of something else? Let me start with the system. Yes, it is rigged against you. It is profitable to keep you poor.